recipes for technical trading success in Cook's Kitchen.
Time to talk about the Rule of 40 again. And this is a handy metric to discuss software valuations. Here was a piece I did in July of 2019 when I was trying to understand the metric and apply it to soaring software valuations into the softosphere, I said. And at the time, I was looking for fundamental and momentum drivers, investor interest in software. And I said there were four major catalysts at the time. Software was primarily immune to the tariff battles. So while the chip stocks were getting hit or other industrial manufacturing, software was immune. It didn't need a warehouse. It didn't need to be shipped. It's all digital all the time. The second aspect is what I call the technology supercycle, where software is such a huge part of vaulting human productivity while taming costs in every industry. So, what Kathy Wood would call deflationary disruptive innovation. The third reason is software is the brains of innovation with nearly infinite capacity to shrink, manipulate, and enhance time and space. Literally, it gives us more time and more space because it's all digital as it vaults productivity. And then software was living in its own valuation stratosphere based on the Rule of 40, where investors were paying 20 times, 30 times, 40 times sales. We're going to look at one today that's reporting earnings tonight. That's trading 45 times sales. Okay, so if you need any historical background on the Rule of 40, I believe this came from the VC Brad Feld in 2015. So you can just Google him, Brad Feld, Rule of 40. And if you want to see a lot of different images, just do a Google image search, Rule of 40 for SaaS. I highlight this one here. Here's a simple way of looking at it because it's taking the revenue growth as just an absolute number. So if you've got 21% revenue growth, just call that 21. In this case, this company right here has 14% revenue growth year over year, and EBITDA, strong EBITDA of 32%. Which adds up to 46%. 14 plus 32 is 46, giving them, putting them over 40, which is what Brad Feld said. He wanted a combination of revenue growth and some metric of profitability, which different investors will use differently, to get us over 40. And so here's a quick example. And again, I consider the Rule of 40 as just a sort of a starting place, something on the workbench. It's not the end-all metric, but at least when you hear an investor or a software analyst throw around the Rule of 40, you don't have to ask any questions. You know exactly what they're talking about. It's sort of a normalizing baseline way of talking about software. Since very few of the companies are going to be profitable, but they may have amazing revenue growth. And so how amazing is it? All right, if you need a quick primer on the Rule of 40, just here's a good article I found from Scale VP. What did I like in this piece? Oh, here's another way where they break it down. Here you've got year-over-year GAAP growth rate revenue of 39.9%, and then EBITDA, excluding SBC, of 3.5%. So you add those together, you get 43.4. Again, it qualifies. All right. Dave Kellogg writes a lot about it. He's been writing about it, probably right after Brad Feld, and he has a lot of good things. So he explains things in detail as a business professor. Unfortunately, his graphics don't expand. So he's got some great graphics here, and you'll see them all over Google too when you do an image search, but they do not expand. We'll have to talk to Dave about that. All right, one last resource, the SaaS CFO. I forgot this. Oh, Ben Murray. How to calculate the Rule of 40 and why it matters. He's got some good graphics here. Growth plus profit. Gets you over 40. Obviously, it gets complex with different SaaS models and how they count recurring revenue, subscription revenue, et cetera, et cetera. This is probably where I got that one Google image exactly from, the first one I showed you. He's got a video on it here. And then he talks about the trade-off, right? Hey, listen, if your growth is high enough, you can be far away from profitability, right? If your revenue growth is high enough. So that's the trade-off there. All right, so let's go to some cool graphics that will help us understand that. This is from KeyBank, and this is something they do once in a while. This is an older one where they plot basically a price to sales ratio on the y-axis. So you've got enterprise value over revenue, essentially price to sales, although enterprise value will be different than the actual market cap of the company. But EV over revenue on the y-axis against revenue growth. So then you get this scatter plot. And so let's see who's, and you want to be up in this this upper right quadrant here. This is the place to be where you've got high revenue. Your revenue growth is, well, actually you don't want to be there. This is what I'm saying. This would be highly valued. You want high revenue growth, but you don't want to be trading for 50 times sales, which the company I mentioned earlier, I said something that's trading at 45 times sales is Snowflake. Snowflake is up here way in the stratosphere. In fact, they had to put an arrow on here because it didn't even fit on the chart. So this would be overvalued up here, 40 to 50 times sales. But Snowflake is growing revenues at 87% this year. So that's why investors will pay 45 times sales. Let's say the company is what is it? 80. Let's call it 80 to 85 billion market cap, and it's just going to breach $1 billion in sales. Oh, I'm sorry. It's breaching $1 billion in sales this year. It'll do 1.8 billion next year. So that gives you that roughly 45 times sales metric. Okay, where you do want to be is in the actual revenue growth, way over here to the right. And you'd prefer to be in the lower right quadrant on a valuation basis. So who's up here in the stratosphere with Snow? CrowdStrike, Datadog, Shopify, Zscaler, Net, I think is Cloudflare. Here's Okta. Here's a little company I like, C3.ai. Unusual name, but they got the ticker right. They got the stock symbol is AI. They IPO'd around the same time as Snowflake, and both if you look at those price charts, let's go take a look at those real quick. I've got Salesforce up here first because they report tonight too. I will show you where Salesforce fits in. And Salesforce, look at this chart, boy. They after that earnings last a year ago, stock just vaulted higher, but then it's been in this, big sideways to down trend, making a nice big bowl here. I mean, this thing has consolidated for so long. I don't think you need a handle on this cup. If the earnings are right and investors like the numbers and the guidance is good, this thing could just blow through 300. So that'll be exciting to see. And I'll show you an analyst who thinks that could happen. All right, so let's look at Snowflake first. So here was Snow after their IPO. IPO was back here in September. Thing launches from, let's say it IPOs at, 240 or something, goes to 420, back down to 180 in May, and then it's just been cruising around here. So this will be a critical report for Snow to see if those high double-digit growth numbers are still there. They're probably not going to repeat 87% next year. The forecast, I think, is like 60%. But if that rises, they're going to keep buying it. All right, so let's see AI. Similar sort of IPO moonshot. IPO is near 100, goes to 100, goes to 180, and then they just kill it. And I'll show you why. The revenue growth is still there, but they're missing something else. I own it. We've been bottom fishing down here. I think whatever Snow reports tonight will influence AI because they also happen to be partners. Snow is like, they call it the cloud data lake, where they want to be data infrastructure for all companies and then be able to bring all service providers together, under the same hood to collaborate to help companies with their data. So, I think it's, they're going way beyond anything that Microsoft or AWS are doing. All right, so back to my graphic for EV to revenue growth, EV to revenue versus growth, right? Remember, you want to be down in here where your growth, you want to be down in this lower right quadrant where your revenue growth is high, but your valuation isn't extreme. You're not trading, 30 times sales. So I circled a few more guys in here. So here's Elastic and Twilio. Here's Paycom and Coupa. In here you got Workday, Alteryx, CRM, Salesforce is in here. Okay, Fastly's in here too. That's why I circled that. Over here we've got Square. So I just wanted to circle that to highlight where Square is. Now I'm going to show you the Rule of 40 graphic for these companies from KeyBank. They do a great job with this. So here's that. And I'm just going to point out the company that I own, C3.ai, is way over here where you don't want to be on the Rule of 40. This is, the Rule of 40 is you want your revenue growth to be high and you want some form of profitability that you can add to that and stay above 40. C3 AI can't do it. So this is actually the Rule of 40 right here. Down on the x-axis is the Rule of 40. So here's your 40%. So this is revenue growth plus, and they use free cash flow margin. C3.ai has negative margins, like minus 33%. And so it wipes out their 33% revenue growth. So let's say their free cash flow margin is probably negative 30. So it takes them down to, they only score a 3 on the Rule of 40. And look at Fastly. Fastly's even worse. So even though Fastly has high revenue growth, they have negative margins. So that's what kills them. So this is what investors and software analysts are looking at with the Rule of 40. And, it's something we want to pay attention to. So let me show you who's crazy about CRM tonight, and that would be Dan Ives. I've had Dan Ives on my podcast before. He's at Wedbush, Managing Director of Equity Research. He says, I think this is the one where we look back, and this is the start of the rocket ship starting to regain fuel going into 2022. And he's specifically talking about Salesforce. He thinks this is the report that will do it. I want to show you another great software analyst on Twitter that you can follow, Beth Kindig. She runs a fund called IO Fund, and she's super sharp and posts a lot of great content about valuations, growth. Let's see, I wanted to show you one of her. Yeah, so here she's got a chart. Cloud software stocks have high expectations going forward, which helps explain their high multiples. And, she's got a lot of the names in here, with, so here's Net, for example, this year growing at 47%, slowing down to 34%, 2 years out, maybe only 29%, and a forward price of sales of 59. These are important things to look at because you don't want to get caught on the wrong side of high valuation when growth is slowing. You can be expanding the multiple, but the growth better be accelerating too. So that's, this is the basic idea behind looking at this sort of stuff. All right, let me see if there's anything else I wanted to show you in this territory. I think I covered it all. So by the time you're watching this video, both Salesforce and Snowflake will have reported, and the cards will fall where they will. So if you bet with Dan Ives, obviously you're already there. You're already looking at Salesforce for the breakout. And if you're long Snowflake, good luck to you, because that's a steep valuation. And if the growth numbers aren't there, could be some pain ahead. All right. Thanks for joining me in the kitchen.